Greetings, market rebels. Welcome to this week's macro measure. It is combined with the sector situation again this week because I find it very difficult at the stage that we're at to see things independently. I feel like there's so much intertwined at the moment that we need to really cover it that way. So my apologies for those folks that really prefer it to be separate and shorter. This is probably going to be a tough week to do that with everything that's emerged. So again, I'm Wayne. This is Sunday, March 17th, 2024, the special St. Patty's Day edition of the macro measure. My partner Ryan there on screen with me. And this is our trusty disclaimer. And this is our trusty intellectual property rights notice. And then we are going to go into point counterpoint. And that's the theme I'm sticking with. It's been that way for a while. And that's really why we've got the sector situation combined with this macro measure this week again, because I just feel as though it's impossible to separate that. Here are the notes for the week. I'll leave those up there for a little while. But I'll just ahead of time apologize for two things. One is we're going to probably be all over the place. Reminder though, first I should note, please go to the highest playback speed because we are going to cover a lot and be all over the place. That'll hopefully help you, and then just dial it down from there to the point where if you can't cover it at 2x, you can cover it at 1.75 or 1.5x on playback speed. Still got the time pressure and home renovations. You may hear that behind me at some point. So I apologize for that, but the real problem though is the just not having the conviction this week to really get to the table pounding point. The last couple of weeks we've definitely moved towards more of a bearish sort of concern, right? Where we said ratchet up your DEFCON level to a high level, get prepared, get ready with your downside put butterflies if this thing starts to break. We finally saw some of this distribution we thought we were seeing finally seem to matter right in the second half of this week, especially. So there's all that stuff and more, obviously, that we're planning on covering today, but we need to reposition a few things. So let me see if I can do that. And then I'll just do this for a minute to get this out of the way. That should be a blank screen. And then let me fix this macro measure stuff here. Okay. And then move this over and then get this on the right. Stop that share and go to a different share. Now that we're off of this one here, we should have NVIDIA with the stretch that we talked about. So we noticed, right, we've been just like a lot of folks, and we're charting the leader. We're keeping an eye on the leader. That's been NVIDIA and especially SMH. And we noticed, right, that the stretch from the 100 and 200 in NVIDIA and SMH in different ways, they were really at historic stretch. You were really at the 99 or 100th percentile. And so we made note of that the prior week, the last week as well. It depends on what you look at. But if you look at SMH2, right, which obviously NVIDIA plays a big role in this, and it's coming up now, but there's your stretch to the 200-day. So even after, as I like to say, the post-COVID madness response, this was really up there. I mean, you're still looking at the highest stretch from the 200 there with that purple dot that I'm trying to show, and that goes back many years, right? You can't even get close to that except for during the COVID response. So that's the issue. You were really that stretch. And remember, there's trillions of dollars that our so-called leaders injected in with various means and mechanisms of the economy back here. So even with that kind of money rolling around, it didn't even become more stretched than it recently has. And some people would say, well, that's because the AI story wasn't at that point where it is now. And obviously, there's some truth to that. But right now, I think you have to look at the fact that it just became historically stretched, and you can still see upside when something gets historically stretched. But the other side of that coin is that, right, you know that you're probably playing on borrowed time. I like to always frame it and say you should really be an aggressive roller. You should already have one foot out the door. you should have everything on a short leash, all those kind of things, because you have to really appreciate the fact that this is not common, right? If you look back 7 years and you don't have a comparison to be able to work with, then you're in something that's really extraordinary. So you can always, right, if you've been rolling and things are going well and you start to see that reversal, you can always take your hopefully a small loss on your last roll, and you still laughed all the way to the bank, and nothing precludes you from, of course, re-entering at a better, potentially better juncture. So that's what I think you have to keep in mind. You don't need to milk that particular trade with that death grip on the steering wheel as if I've got to get this 100% right or there's no future for me in this world, right? That's not the case, because you can just, again, live to trade another day and you can get right back in if you want. But this was something that became utterly ridiculous. There's no way really that with 100% certainty that I know of that you can predict just exactly how ridiculous something will become. But that was really a remarkable, remarkable situation right there. And I think it's smart to trade the long side of it, but when you do get this extended, it's also smart to be on the right side of the position management. And then what that basically means is that you're just not overstaying your welcome. So even with the situation that this thing topped out and backed off, even with that, it still registers on NVIDIA an 84 RSI reading on the monthly. It still has an 89 reading on the weekly. So that just gives you an idea. These are bigger picture timeframes that don't often become that overbought, and they don't stay that overbought for very long. And naturally, the daily was probably, I can't go back and show what that was at the time. I guess I could if I went to another screen, but it would be hard to really see at the top because this is all based on closing data. But the daily RSI there, of course, was probably absurdly high as well. So again, there's no guarantee that you could say, well, how do you know it couldn't keep going? I would never argue that it couldn't. It's just that you know that you're playing really against the history, right? You're playing against the history of the statistics. And that's something I really don't like to do, especially lightly, especially where there's great risk involved. So that's why I was harping on this so much. If anyone's wondering why is Razzi throwing these graphics in to the Rebel Pit Elite chat and all this stuff, it's just because this is the leader, right? This affects the other stocks that are in, it affects SMH as a weight, it affects the indices as a weight, and so on and so forth. So you have to really look at it, I think, that way to some extent, and then be prepared for when this becomes too excessive, that could then hamper the market. And speaking of hampering the market, when you've got heavyweights like NVIDIA and you've got heavyweights like Apple that are coming under pressure, that can hamper the market. And so this is not a good look, right, with Apple. Let me try to get us a little bit more. This is something I wanted to make sure we covered, but this is not really a good look with Apple. This is the weekly chart, so let's switch back to the daily. Apple really struggling, right? Topped out just under 200 and has been really under pressure mostly ever since. There was one little burst here that we got lucky, I think, there and had a nice little, after this, I mean, there were ideas leading up to this, but we had one little burst we were able to catch there. Some folks caught a little tiny single, maybe bunt single of a trade here, but ever since it failed to hold the 200 there in purple, it's been in trouble. So you've got potentially, right, NVIDIA sort of maybe, who knows, maybe cooling off at, let's say, kind of being more neutral, maybe not helping the market the way that it has. Massive weight in Apple maybe having an issue. Everyone probably knows at this point that another big name, Tesla, is having an issue. You can see that right there, right? That's below the lower Bollinger Band right now, and it's got a 29 reading on the daily, right? So if you want to find something that's oversold, there you go. But another, right, not big stock, but still bigger name. You all know what happened here with Adobe, probably, right, with this kind of a reaction. So there are some cracks showing in individual names, and there's also that super stretch that we got, and usually the aftermath of something that becomes super stretched the way that NVIDIA and SMH did, usually it's not good. Usually, right, you kind of get a little bit of a reversion to the mean. The stock still stays relatively high. It allows these SMAs to keep trending up and get closer to the action. But it's a combination of the price is still being above the moving average, adding to the moving average as one day from the past lops off and a new higher price stock close gets added to the calculation. So the SMAs, the longer term ones, tend to work their way up as the stock is even working its way down. And that closes the great stretch that existed between the two, as I'm saying, in SMH and NVIDIA. So I don't know. Again, this is all all stuff that would be I would be happy to change my tune on, and we'd be willing to change my tune on, and would objectively try to change my tune on in a heartbeat, because I think that's what the market requires of us, and that's what I was taught by the market many moons ago. I finally learned it, and didn't continue thinking no, that's not the case. But you can see that there's a support line. I'll make it blue there in SMH, since this is, I consider this the leader and the key area. And that 20-day, it kind of came into there. We were thinking, we mentioned this, I think that it could maybe come down to there and then it would get serious. And that's where it is. There's a little bit of support right underneath it in the form of the support line, I think. So there's something there. We'll see. There's also kind of a flatline-ish situation, kind of where it hesitated there. It's right near those 100% fib. So it all kind of makes sense that let's just put a number on it. Let's say 213 for now is probably, maybe 212 to 213 is a big shelf there in terms of support. And if that doesn't hold, then you start looking at the 50 here in gold. Then you start looking at this gap here that's very prominent as well. You start figuring, and they're in a similar location as well in terms of the level they're at. So just food for thought if there is more to this. I think if I can get us there, let's see if I can get us there. No, that is not it. We have to go all the way to the bottom to get ourselves here. So this is what I mean by jumping around. So my bad, just please bear with me. I'm trying to find some sinks and vanities that my wife will be happy with. Get these projects done. So here is this. So yeah, so this is what I wanted to grab for us. I'm gonna make sure it's sharing the right thing. But US stock performance, we've been charting this now since really, I think we started really looking at it a little bit in 22, but it was very prominent in 23. And again, it's sort of been on target in 24 to this point. So as long as it keeps tracking fairly well, right, we're going to keep it in mind, at least take a glance at it. And as a lot of you know already, the fourth year that we're in of the presidential election cycle is the second best year historically. Last year, of course, was the best of the four, and typically that's the case. Now, when you have primaries, here's years with no presidential election. Here's years with presidential election. Here's the primary range, right, where you have these primaries date-wise. And you can see that in the years of presidential elections, as we've been noting, as you get towards the second half of March, which we just got towards, late last week into right now, that's when the market has often topped out and then struggled for a while. So because this has been tracking well, and because things became very overbought and very stretched, and a lot of metrics were saying that it was excessive, and as many of you know, there hasn't been a real 2% pullback on any given day for months and months and months on end. It's been relentless. All these types of factors, combined with the fact that there are some signs emerging on the charts that are concerning. This is why I've been writing what I've written on our notes, which should be right here, which are these, right here. I've been saying, and I modified it since I started it 2 weeks ago, but we still sense the remaining 1.5 months may see the return of risk in a significant way. You may want to have your downside put butterflies pre-selected. So that's something you can cover, again, with Ryan and Greg. With all the webinars that we do each and every week, you should be able to get adequate coverage. If you're a part of some services, Bill Johnson's available, who's the best around. He's a friend and former partner, but I still think Bill's just top notch, absolutely top notch, and does a just tremendous job of conveying so many ways of painting pictures for folks so they understand things, different perspectives, He's just really great at what he does, and you can get in there with him. We've got Scott and Stu as coaches that help out with certain things as well. So you can learn all about that type of stuff. But it's something we really like because it's got a you can morph it, modify it, whatever you want to call it, and you get you can really get a great return for at least initially not putting a lot of capital at risk. But that's a whole nother matter. I just think if you know what that's all about, you ought to get prepared for that. And I'm not saying a crash is coming. I'm just saying that I think there will be a little more likely, there's more likely to be more corrective activity. But the problem is, and you can see that really, right? That's typically what happens in this fourth year. The problem is, right, you can see that's really not the case. It's really opposite in versus the other 3 years. So it's kind of coming on schedule. And some of these things are due to where's my I wanted to show where's my I almost feel like a chart's missing here. What am I missing? Is it this one? That's not it. It might be this one here. Yeah, so the reason I'm saying that, what I think I'm going to do is I'll pull the one without the RSIs over here. It's got a little bit better of a view for everyone, but this is why this is so intertwined to me. So, right, normally you would say if energy's healthy, financials are healthy, transports are healthy. These are important factors, right? You also want to see things like discretionary here, XLY, all these things. There's a bid for materials and industrials, ideally. Tech and communications are doing well, but really, some of the big three I think are energy looks good, XTN transports are looking good, and financials are looking good. So the financial system's working well. There's demand for energy, which is obviously broad and important, and transport, especially right with all the commerce that moves through shipping these days, direct to consumer, et cetera. That would be a big deal. But this is a problem. We've been noting that this is one of the missing elements. And you could see that the transports had a rough week. They failed to break out, right? They started to make their move, consolidated, and then really put one little attempt together the prior week, and then they were looking like they were trying to do something. They reversed hard, I think, on that Friday, and it's been rough ever since. And that's not a good sign for the economy. These financials have been practically bulletproof, but they're getting, I think, a little long in the tooth. So let me bring up for those. Let me bring up my other. Oh, that's not it. Oops, it should be here. I'll bring those up, but you can see were at a higher RSI reading. Okay, so I'll move those out of the way now, but they were, I think, nearing 70. So those were getting up there. Tells me really not that there's an imminent collapse, but right, that the grind has been so long and so consistent that they became basically short-term overbought. I don't think anything awful is there in terms of, oh, I know this thing's going to crack or whatever. I do think the regional situation could crop up and turn into something. We haven't taken that off of our radar. We continue to note that, but you don't see good things right now. Look at this discretionary here, XLY, right? I'm trying to get that highlighted. That the last couple of weeks in there, when it was tracking well with XLP, not looking good. I think just overall it was risk off towards the latter half of the week. So even XLP got sold into, but this is important. This did not break out. And you could see that real estate, which was, again, sort of continues to mystify me in a very simple way, but that had a really rough week, right? So it's sort of like that area. We know that there's risk there. The risk could crop up there in a big way. We've talked about commercial real estate, talked about housing prices, affordability due to higher rates, the whole works, inflation and what that's done, and the fact that salaries income hasn't kept up with inflation, and how does that bode well for these XHB players? But that's why we wait for the charts to tell us what to do, because they've continued to say all of your theory or your big macro discussion doesn't apply yet, and it hasn't. But XLRE had a rough week. I put trades in IYR. I think IYR did trigger. I do think it fell, another real estate ETF that you can look into. But XLC, right? These are the former leaders, XLK and XLC. Those which were leading, they've both tried again and failed to break out. So it's not that their goose is cooked, but they continue to try to want to regain their shine, but they just can't. They haven't been able to do it, right? So you start looking at that XLV, which was doing exceptionally well. That's also moved into consolidation, right? So I think overall, staples being bid a lot more than discretionary. The transports being problematic. I think XLE is up here. That's only going to hurt the consumer at the pump, in my opinion. I don't see that as it's a positive in the sense that if inflation wasn't already a problem hurting consumers, that really wouldn't be the biggest deal. But I think it just adds to the consumer's challenges right now. So that to me is more of a negative at the moment. And then we haven't talked about utilities, but because we usually just gloss over them because that's really their space they occupy. They should be glossed over. But even though rates have come up, which we'll talk about, these things have suddenly, right, they've been doing a lot better. That's more of a defensive positioning historically. So you've got really XLB and XLI that are now both, and I didn't want to do that. Both of those look more I don't want to do this at all. Let's just get out of that. They both look a little concerning that they could lose their support line that I'll put underneath there if it lets me. So that to me, right, these are also been very strong. They've sort of been leaders in their own way. And I think you've got to be concerned about those because they're really right. I think they're right. Like that is right on support, if you ask me. This is right below the most aggressive support that I can draw. And that's how I like to do it. And then go from there and find other forms of support to see where the stock may find it and hopefully hold at some point, or in this case, the ETF. But we're not going to go through all of the ETFs at this point. I'm sorry, all the sector ETFs. I'm just saying that making the macro case at the moment that a lot of this sort of, to me, adds up to be a more concerning situation. And then if we drop down to a regular chart, let's just look at something like this, which has been TNX. And we've been telling folks now for a couple of years, ever since the rate rises began, that you've got to keep your eye on what the dollar, it's more important than in times like this, in my opinion, to keep your eye on the dollar, keep your eye on yields. And you can see that the market was roaring as we got into this point here. I'm sorry, the market was roaring into the end of the year, but then it continued to do that even though the yields were moving up. It kind of ignored them to a great extent, but now they're somewhat threatening to take out the highest recent high. They're not very far away from there. So with that being the case, if these yields continue to move up, right, that could start to become more of an issue for the market. And that's been the argument all of you that tune in, week out, have heard me make, is that for the second year in a row, I think the sales pitch that the bulls made to everyone has turned out to be hollow, right? It was all about rates lower sooner. Last year, rates continued to climb in the face of that argument. This year, rates have not, even though they're a whole year later, and you're very far removed in terms of months from the most recent rate increase, you still have not seen these rates really begin to definitely say top out and roll over to making new lows if we observe this TNX, right? These yields are just not doing that right now. And so I think there's still a possibility that the June hopefuls, right, for the next rate cut with looks like March and May being a no-go by probabilistically speaking. If you go to the CME website, they still favor something happening in June, but not by much versus sitting still. And I think that's probably a little premature that they're leaning that way. But again, I would defer to the market over myself. It's not like I follow all that stuff all day, every day, the way that the market itself does. And so for now, I'll sort of buy into it. But I think it would take the fact is that I think it would take something pretty negative to start really showing up quickly for the Fed to suddenly start to make that move, because really that's only, and it's only about 3 months away. And it doesn't seem to me like, with the current trajectory that we're on, with the way the inflation data is unfolding, that is likely to result in a cut. So I think it would take something that would be negative, that would shock maybe the economy to some extent, for them to have to start doing that, to start actually decreasing rates. And remember, at this point, this is worth noting, and I'll bring the graphic up in the future again. I'll find it and bring it up in one of the upcoming videos. At least I'll plan to. Look, when they start raising rates, when they start lowering rates, that's where things become problematic for stocks in the aftermath. The year after that happens, usually the market's down more than 10%. That's according to the historical performance that was done by someone from the Ritholtz group. Anyway, that's where things are in terms of TNX, which you got to keep your eyes on. These things keep rising. I think this is going to continue to be a problem. The dollar continues to also work its way back up. Well, and overall, okay, after it was kind of being left for dead there, but then suddenly revived back to life. And if we put a resistance line on here, it's a very simple technique. All we have to do is do this. I'm not even worried about drawing it perfectly. I'm just going to kind of put it there. You can see there are some SMAs in its way on the way back up, but that could be the end of this corrective phase if it breaks out from there. And all it would really need to do, I think, would be to get above the 100, which is at 103.718. So if it gets through there, it only has the 150 remaining, and then obviously you're seeing if it can take out these highs. But if it can do that, that's right. That to me is a problem if it starts to work its way back up. I don't think that I could be wrong, of course. I don't think the dollar. Well, I should say that the dollar getting up here, that doesn't surprise me. But the TNX actually taking out the highest highs that it registered since rates started to go up, which is just under 5, right around 5%. That to me would be surprising. And I even though I'm saying that it's possible that it starts working its way back up from here and causes problems, I would be surprised if rates somehow, the 10-year yield, I should say, eclipse that. We'll see. I'm not expecting that to happen, but I think that would be even a bigger problem. But again, what do I know? But another interesting thing that we have to note this week, because we kind of laughed the VIX off because of what's happened to it in recent years. It's become really, I don't know, bereft of interesting developments, would be one way to put it. It's had its moments here and there, like it always does, but it just seems like it's always, it's almost always in a threatening to kind of work its way lower a lot more than higher, right? With some of these extended rallies that we've seen. But interestingly, right, not really the chart so much, just the idea that it's stayed well off of this low now for a while. So folks are sensing something. They did try to pull this thing up in the last couple of days of the week back to where it was, where they ended the prior week and where they began this week. But that, they kind of worked it back down, not shocking for a Friday. But I think what's interesting, if I can get us there, is that this is what I really wanted to show as part of our all over the board presentation. There's been a real drought in VIX call buying. We haven't had anything in UOA Elite for, I think, since late November was the most recent prior hit. But these are pretty big. I mean, you've got 150,000 22 May 35 calls being bought, and you've also got 150,000 18 June 35 calls being bought. So these are combined, these are some of the largest VIX call hits I've ever seen. And so this could be, right, this could be the so-called 50-cent VIX trader coming in, doing their thing. You've got, this is just under 50 cents. I don't know what the June 35s went for. Could be somewhere in that vicinity, not positive. For some reason, that might have been omitted here. But obviously, it's exceptionally large, and you just don't see this often. As I said, the prior hit was about late, I want to say late November, the most recent prior hit. So I did kind of note this for everyone so they saw that. Anyway, that's something to keep in mind just because that player, they've missed on a few, but they've also had some big scores and they're back. And it looks like they're expecting something over the next 3 months, roughly speaking. So don't know what that would be. Now, this is very interesting as well. As I was saying, I don't try to go around looking for things to nitpick about a market that's acting bullishly. But if you look at the new high, new lows, the way Sven Henrich has presented them here, it's pretty bad, right? This is I think, new highs, new lows, cumulative. It's a cumulative line. And I think what they're doing is they're looking at the entire market. And you can see that during the way he has it presented, right, you can see the blue is when they're cumulatively picking up, and red is when they're basically right retracing that, and you're getting new lows over new highs, and you're backing up cumulatively. And so you can see that this is really another situation where this is just missing, right? This bullish activity in the SPX, these were all these major rallies over the last couple of decades were accompanied by much better participation in terms of new highs versus new lows, cumulatively speaking, than now. So that's a real issue. I did bring it up on my trading view, and it might not be identical, but it gives, and I've got the Qs plotted here, but you can see that there really is a big chasm, right? It depends on how I can sort of adjust this to sort of show, right, how things have played out. I don't think it's really something that you want to say like is something exact, right? And it needs to be set up a certain way. It's really just trying to get a good view at it. And you could see that we go back and back and back. And I don't know why I can't go back further. Let's see if it lets me go back further with SPX this way. And I can get a better view on things for us there that way. And I think maybe that lets me do that. It looks like I have to scroll back in time. They really want me to scroll to get there. But you can see the prior bull markets. You can just make that out. And you can just see that this chasm, right, between what we're seeing right now and what's happening. So this is sort of the counterbalance to everyone that's saying, oh, no, this is everything's wonderful. There's a lot of people that with no problems. I try to be objective about it. I do think this was a good thing to point out because this whole thing does feel different to me. We have obviously been going with it because we're big believers in the trend and momentum and trends persisting, so we've been going with it. But this is the kind of background information that I like to share with folks and keep track of myself, obviously, so that we can really appreciate the risk side of the equation. And I think that's what you have to do here. I don't even know what this is. That's nothing. Okay, yeah, so that was just leftover stuff that I was looking at on Twitter. But I did go and find the Sven Henrich graphic for everybody. We talked about it on Cocktail Hour on Friday. And you can just see that there's a pretty good correlation to this historically. And that is, to say that it's missing is probably an understatement. I mean, this is just dramatic, dramatic, dramatic. So you would say, well, that's probably a problem. It could be, right? But it really depends on if it really is. It probably is. But if it really is, when does that start to matter? And it really doesn't matter until trends get broken. That's the reality, right? So that's why you have me harping on things like okay, what's going on? Okay, but is the trend, we're in this kind of tough sort of no man's land where we can't get short. We don't want to fight against this thing yet. It's been so resilient with this leadership area being the SMH that every time you thought it was about to roll over and crack some support, what they did was kind of momentarily show weakness and then came right back after it. And they've been merciless about, as usual, right? If someone gets drawn in, like they might have, let's say here, and I'll move this oval just so everyone can see it better. But if you see something like this where you think it's breaking down below that 20-day, and you think that 20-day there in light blue is important, and you sell it, and then they work it by the end of the day, they work it back up and close near the highs. If you're not disciplined, they're immediately annihilating you. And this happens a lot in very strong uptrends, which is why we're very big on triggering. I mean, it's triggering at the close. Sometimes you can't wait until the close because, right, something's breaking down earlier in the day and you really don't want to wait. I get that, but you have to be disciplined about it and say, look, I'm going to give it a little time. But when the action reverses and you close at the high, right, that is basically their perfect trap, and they're great at setting it. And they'll take anything they can work with, and they'll use that and draw people in. So that's one of my notes for the week. You have to realize that fresh shorts could have been drawn in here with it breaking short-term support lines like the blue one I just highlighted and extended. That got broken. The 10-day got broken here in white. The 15-day in red got broken. And you held just above the 20 and they saved it again for now. But as I said, there could be more. So this is dicey. This is why this week you have to realize that they have backed this thing off pretty decently, right? From the high of 239 to the low of, what was it? 216, let's call it. So that's 23 points roughly, right? So that's almost what, a 10% drop almost. So that's pretty big inside of a week and a half. Now, granted, it was out of control, but that's so the aftermath is this. I get that, but I'm just saying that it wouldn't be shocking, right, for them to feign a little bit more weakness and then try to put a reversal together. So it's a very interesting week in that you could have some sell-on news where you have to, I've got that noted somewhere on here, that you've got this big tech conference that everyone wants to tune into as if it's the Super Bowl. And that usually is when everyone's really keyed up for something, it becomes very emotional, and it can be a real bait and switch by the gang, which is something they're really, really good at. So you've got that, and you've got the FOMC, which, as many of you know, they often will play games in front of it, during it and after it. And so it's very hard to even know how that's going to completely shake out. And remember, they'll spin anything. So something that they'll always explain something away if it doesn't fit their narrative. That's the way of the world at this point. But certainly it's always been the way of Wall Street in the 30 plus years that I've been on it, figuratively speaking, of course. But those are just some of the points I would note. Let's cover some of these while we're here, and then we'll go back to the charts. So so here we go. So the back half, again, that's a break with a pattern. We saw strong back half of the week performance most of this year since really the October bottoms. That hasn't happened. We're asking the question, right? What's going on with that? Is that the start of something, or is it just, okay, we're kind of approaching this FOMC and some people have had such an incredible run and they're just taking some profits off the table and maybe getting ready to rotate into something they perceive as a better value or about something that's about to emerge? Totally possible, right? And remember, the trend hasn't been broken. That SMH being the leader, that is the concern because it's near support now, right? We don't really have to worry about it breaking the trend if it's not near support, but now that it's gotten near the intermediate term support, to me, now you have to be concerned about it, especially because I think it's the late innings. I don't mean late innings that we can't go higher in a few weeks. I just mean for this particular phase we've been in now that's persisted for, well, about 5 months. We've had basically 5 months of almost incessant rallying. And so, as we've noted, right, that's relatively rare. And it's another reason why, right, this type of a period doesn't normally last forever. And that's another reason why I'm thinking that there should be some corrective action in the next 6 weeks. Now that we knocked 2 off of my original 2-month time window. I do think you should be a DEFCON for these reasons. You have to just acknowledge the fact that if TNX especially breaks out, that could definitely become concerning, and you could see more money act defensively, and there could be more money profits taken off the table. And remember that everybody thinks they're going to be the first one out the door. And when that's the case, it can create very quick, right, really quick downdrafts that happen very quickly. So again, another reason that if you're riding longs and they continue to work, You have to be diligent, I think, about rolling and managing your risk, even if things are working. Don't let them lull you into a false sense of security too soon. Let's see. So yeah, I think the missing participants that we talked about, IWM is missing. We'll go back and look at that on the charts anyway. Breadth has been good, but started to roll over. And you also have your XTN is missing, and a lot of leadership sectors are now looking a little tired and maybe at risk. It would take more selling to bring them to support to really put them at serious risk, but they're not performing well right now. It might just be, well, that's natural after the run they've had in front of FOMC, right? People are just being smart. The other thing, just like we say that there could be sell-on news with this tech conference, the world's most watched tech conference, but the other factor would be that, remember, there's probably been a lot of frustrated but patient bears out there. And now that they see some kind of weakness forming, some leadership stocks, big names starting to get smacked down, like we talked about Apple, Tesla, Adobe, others, even Nvidia correcting 10%, they might be encouraged. But remember, that's brought in fresh shorts. A lot of people have probably tried to short this thing and not fared very well as a result. But now it's looking even worse than it has before, right? With cracking this 20-day and maybe right on its way to the 50 down here and maybe retracing more. It certainly hasn't retraced much. Let me throw a retracement on here for us. I'll get rid of this extension for now. Can always bring it back. And then what we'll do is we'll just put on a retracement, since we are talking about the Qs, which are obviously important. Big trader. Right, so 440, I need to make an adjustment here. I'll get us dialed into the penny on it. 448, 864. And the low we've got down there is what was that low that day? 342.35. So let's see where that puts us. Okay. And you could, yeah, so we've got, oh, it's drawing another one on me. What happened there? I thought it was locked. Well, I thought it was locked in there. But anyway, must have picked up another one. But anyway, you can see that the 23.6 retracement puts us down really to just below the 50. That would be a natural level. You can see there was some trading around that shows me that the level was already expected. I mean, it was already respected. So that to me matters as a level. When I see that, it matters a little bit more. So because on the way up, it sort of respected that level. So I do think that would be an important area. Probably don't want to see things get cracked too much below there. And that's really the way the prices are at this point, right? That's really only a little bit more than 2%, right? Somewhere around there. It's not that much. So that would be great. That would probably be a great spot for bulls, because they would have gotten everyone a little concerned cracking through that rising 50 there in gold. They could potentially try to put up a stand there, and then that might be the oversold bounce level, that they could try to work with in the short run. Clearly, though, you could see where everything else is, in the 38.2 dovetail with the rising 100 SMA in there. And you can see that also was respected on the way up, where we traded around it, closed near it, put some highs in near it, some lows in near it. So that, again, is a pretty respected level. But remember, too, and I think I wanted to show this, we saw I'll go to NVIDIA to show it, but we saw that this big picture cup and handle pattern was something we were spotting in the fall, that we were saying, right, we got to keep our eyes on this, because this is a pretty reliable pattern. At least in my experience, I like that pattern. I think it usually delivers the goods more than most patterns. And this kind of cup and handle was forming. And that's why we were saying, this could really turn out to be a monster situation in the market, in certain things that were exhibiting. And a lot of different things were exhibiting this cup and handle. And the cup and handle, certainly, I don't think anyone that was trading it in NVIDIA was disappointed. I wouldn't think that if you were a cup and handle long there, you were disappointed all that much by how NVIDIA performed. So that was showing up there. A lot of that stuff is fired, but to kind of bring it back a little bit more, kind of a little more full circle, let's go to the cues again, and we'll see that what hasn't really happened though, this one did fire as well. The cup and handles in there. You can sort of see the cup through here, and I know I'm on Fibonacci, and I've got the pencil going there. But here's the cursor, right? There's your cup, there's your handle. You fire naturally, right? One stock versus 100 stocks, it's a different story, but still, it delivered the goods pretty strongly. I mean, if you got long on that breakout and you were waiting for a larger move, playing something for maybe with like a multi-month contract, you were probably quite happy the way things have turned out, but we haven't come back completely. We did kind of touch here on a pullback, but a lot of times you'll see an even larger pullback to the former high, which would be in here, and then they'll pull back to that point, and then they'll start to go again. You want to see this get tested kind of in a bigger picture way, and then hold and go again. That would be definitely would be encouraging, right, for I think a lot of technicians out there. So just something to keep in mind, that you could sort of have not that sort of initial pullback that we saw that was valid and held, and we still ran from there, but more of a bigger picture chart view that delivers a more extensive pullback that doesn't allow for the price of the ETF to drop below and really close below in a significant way this all-time, what was formerly the all-time high. And then if they start moving it back up from there, right, that's something that puts a lot of people at ease, makes them feel better that we really are embarking on something bigger. I don't want to get too far ahead. I just want to mention some of these points. Okay, but the same thing would really apply in SPY, because SPY had that similar view, right? On the weekly, it was very easy to see the cup and handle patterns forming in different stocks, different sectors in the major index ETFs, all that kind of stuff. So they all formed, they delivered very well. I mean, this is a great start to whatever phase you think we're in. If you think we're in the start of a wave 3, and this is wave 1 of 5 of wave 3, right? You've got to love that. You could say, well, no, I think this is wave 3 of wave 3. I'm not even getting drawn into Elliott wave arguments, because I have nothing against Elliott wave. It just when experts disagree as much and as often as they do, it's pretty hard for me to be as emphatic as someone who is not at their level, right? I can't really get that much conviction from Elliott wave. I feel like there's a lot of bright people that apply the Elliott wave, but again, when they're at odds with each other, and I've seen them call more tops and that would lead to catastrophes than has ever happened, and it's not a knock on them. I just think that they're very much true believers in Elliott wave, and a lot of times I think it just misleads them. And I think, frankly, what really happens is that they sort of view the game as contained, right? It's sort of this contained game, but what we all know is that when everything spirals out of control and the rules of the game no longer apply, because the authorities, so-called authorities, step in and rig the game to continue, and that's how you get kicked the can for as long as we've had, and the rest of it. That's how you end up with all these messes ultimately. But that's why I think that's part of why I think that they have trouble, is that their system that they're making, they're kind of having this finite ecosystem view at the moment, and then the ecosystem is artificially shifted by the powers that be, and then the fun or party goes on. And again, it's not a knock on them, so please don't take it that way. I just feel like that's an omission that you've got to factor in, because 1999 proved to me how absurd things can get when so many things just traded at levels where they would never see again or even come close to. And again, like, you try to make sense out of that, it's hard to make sense out of that. So if you would really sit out and miss a lot of this great trading opportunity if you take some of these sort of finite views in. But now, right, what we have to do, getting back to the present, is realize, right, that this has been a tremendous, not only sustained run with very little retracement, but it's also getting a little bit long in the tooth. You can see how vertical it is depending on how you want to view it. And it really is due for more. So it may end up where all we get over the next 6 weeks is more of corrective action in the form of a consolidation that holds on to most of these gains. But at the same time, right, you can see that with the gaps that were left and the possibilities that are out there, and something I feel like could come out of left field. I do still feel like the regional banking situation is not completely settled. Other things like that, geopolitically, I feel like politically, geopolitically, a lot of things could happen. And I think you got to be on guard for that. So that's it. But right now, you're at a point where you could really lose the intermediate term support there in the form of the 20. Buying just above or near the 20 has been as it often is during strong bull phases. It's been right a tremendous place to step in at once they've sort of taken it below and then brought it back above. There's been trades, some of them longer duration, some shorter, but anytime you got near here, there was pretty much a bounce. So just be ready for that. Be ready for new shorts being drawn in. And if you don't get that breakdown, if you trade the breakdown, that's fine, right? I would be willing to trade both. And I know I'm kind of contradicting myself because I do talk about not liking to counter trend trade that often, but I feel like we just reached extremes. And so it becomes more interesting, but they often do not make it easy for you. And you will have a lot of company. And for that reason, if you don't get the follow through, if there is breakdown and you don't get the follow through, don't overstay your welcome and let these guys shred you. That's what they'll do. So take your shot if you see things that way, but don't overstay your welcome and let them just cause instant pain for you. Because the longer you wait to react, that the fact that it's now back above your trigger level usually ends in even more pain. Usually, not always, but usually. So I'm just sharing that because I learned it the hard way almost 3 decades ago. So just be wary of that. Now, let's talk. I know we've covered a lot of things. Um, yeah, let's cover IWM because that again, that's still a missing element, right? If you say, well, where were the problems a couple of weeks ago? We said IWM and XTN, and then with the shift in gold, and with a shift in the dollar and yields moving up this week too, these are all concerning signs. Here's another great example of what we just discussed, where you get the breakout move and it looks like it's finally going to start joining the party more, right? But because you've got to look at TNX and the like, this is definitely an interest rate sensitive area, right? IWM with these smaller companies. So when TNX starts to bottom out and then starts to lift, you get this big reversal here. This is why you can't, in my opinion, just watch things in a vacuum, right? I think you've got to say, well, oh, okay, well, this is not good for me that TNX is doing its thing. So that helped to undermine this breakout attempt. And then again, if you bought that and you see this isn't working, it's reversing as hard as it did, and you see the yields are going up, which kind of makes sense that that IWM would be under pressure, then you've got to just take your small loss and move on. There's nothing wrong with taking the small loss and moving on at that point. So, you could do whatever you want. If you're me, you're going to put a support line under there. And really, right, once Monday came and you fell below there, that would have been it for me. I would have, even if I held on here, I would have said, it broke support. I'd rather not death grip this thing and hold on. What I'd rather do is if it does start to show another attempt to break out, I'd rather get back in again I'd rather take a small loss now and with a plan to maybe get back in than to hold on, and allow these guys to make life even more miserable for me. So this is a failure to really break out and hold and go, losing the short-term support there that we just showed. You're below your 20-day now. You're on your way maybe to the 50-day, which could open up the door to more. So again, that to me is not a good sign. Anything could change this week with the Fed. That's the big wild card. It always is. It's really hard. Again, like I said, it's very hard for me to get conviction about these things when I know that there's two major news events that are planned, let alone unplanned, right? So I think that's why it's going to just be look, let's trade what's in front of us completely. Let's be ready to go. Let's be super disciplined. Let's not get caught, right? It's been a great run. Let's not put a massively large bet on at a dicey time, get it wrong, overstay our welcome, and then really take a beating. It's sometimes, and Greg does a great job of reminding people, sometimes the best thing you can do is just avoid a bad trade, right? Or making a trade that looked good that starts going bad turn into a bigger problem, right? That's what you don't want to do. You don't want to spend your time focused on the negative. You want to focus on the positive. And if you hold on to negative positions, it can be psychologically debilitating, and it keeps you from focusing on emerging opportunities because you're worried about this, that, and the other thing. So again, it all argues for quick, short, cutting. We should say cutting short, right? You're losers. Just say, boom, done. I'm out. I'd rather reload again if another opportunity presents itself rather than fighting with these things. But look, the diamonds, right? They were not able to, we did note that they might have a double top. Interestingly, right, that they were maybe had to be on the watch for a lower high, possible double top. They kind of formed that could be happening on the short term. They were not performing the way SPY and QQQ were, and certainly SMH was the leader. And it's been a hell of a run. Remember, you go from about 2,000 up to nearly 40,000 in just 6 months, 5 months. So that's a hell of a run. Little retracement here would not be out of the question, that type of a thing. So again, I don't know what would cause a catastrophic failure of the equity market suddenly. I feel like it would be something that starts bubbling up in the financial system usually, or it could be a geopolitical situation that fires, the market starts selling off, and then other factors contribute to it, like financial system issues that crop up or come out almost concurrent with some kind of a geopolitical reaction. But that would be it for me in terms of those. Now, let's see what else we need to cover to make sure we go through all this stuff. I did show you the cumulative new high, new lows for the entire market. They are not anywhere near where they should be relative to prior performance. You know all this. I did talk about being careful with what you do in terms of fresh shorts being drawn in. That's counterbalanced by, right, the world's most watched situation, right, where it could be a sell on news with this tech conference because of the ballyhooed factor coming into it. So you got to be ready. I still think we saw some distribution. I think we were right about that. I think risks have grown. Again, banking system tremors are there. The metals and black gold, even the Utes. The Utes got bid. They held in there this week despite rates going up. They didn't keep going, but they hung in there, I'd say. And you have to remember now, we already showed XLE has moved up, and precious metals, which I'll show right now, have moved up. So, these with the dollar being able to do what it did, it's this week. The fact that metals moved up is a lot like utilities hanging in there, where people are concerned enough that they're not. When the dollar moves up, usually metals are going down and vice versa. But that did not happen. So I do think that this burst we've seen in this space is a concerning sign. It's been dead money, I think, for a while. They did start to look better finally, right? And we did, luckily, there and XLE, we kind of were able to catch that and stick and move with it, and get ready for it. We have had some trades in there. Some of them worked out. They have not been gangbuster grand slams, though. XLE trades and metals trades have been maybe single, maybe double type, not anything spectacular. I don't have everyone's returns memorized, but it kind of disappointing given the kind of move we saw out of these ETFs, right? The ETFs themselves look pretty impressive with the sharpness of the move within a relatively short period of time, but the ideas we had, they did okay. I would call it okay to good, but not great, which is a little disappointing. You want to do really well when you're all over something. I think we were all over the changes of the charts and the changing of the charting complexions in those areas, and just I guess mediocre would be another way to put it. Not look, we won rather than lost, so you can't complain too much. But it's just not. Sometimes you build it up in your mind when you're getting in early. You think you're getting in early and you're timing things nicely, and you think that you should get the score, and then the ETFs perform, and your stocks are like, eh. But oh well, it's going to happen sometimes that way. Talked about this elevated risks in the short term. There has been a lack of a real pullback. There are downside gaps. Sector issues are portending problems. I did say volatility would pick up. So a lot of this big picture stuff I discussed that I kind of put here for notes. I think I discussed that. It's been an excellent trend to trade. I still think there could be more upside to come, even sooner, but definitely later. But I do think the more likely scenario is you're due for a little bit more of a pullback, to say the least, in the short run. I think, like I said, in the next 6 weeks is when it would make sense for a lot of reasons to me. The market doesn't always make sense, obviously, but I would be ready because we are at risk of cracking support. I'd be ready on that, but I already discussed how you should handle it. Every time I try to, and I think a lot of people get frustrated because I put these reminders in, but I always think of the new person. I'm always thinking of who's the new guy or gal that just came into Market Rebellion or discovered how we approach things on YouTube or on Twitter. And they're thinking, well, what are these guys got to say? And what we've got to say is that that people that observe, guidelines and that are well founded, that observe the market truisms, and the people that stick to their discipline and manage things properly and know what they're doing, those people do quite well. That's what we're about trying to do in terms of helping people. It's not it's not a get rich quick scheme. Even UOA, which tends to produce outsized gains relative to just simple momentum trading at times, that is not a get rich quick scheme either. It's more of I've got to grind it out. Trading in the market is grinding it out, and that's what we try to do. We just try to be smart as we can as we're doing it, and sometimes that means being more aggressive in the earlier innings, and sometimes and middle innings too. But in the later innings, right, we want to be smart and not get caught holding the bag or for a rug pull, right? So that's what I'm worried about right now, more than missing out on gains. I think if there is going to be a gain, I think it's going to have to do with squeezing on news, right? Where they'll just use the usual concerns that have built up against people. And again, that's some of these fresh shorts that have been drawn in. Those people are at risk. Okay, so and any fresh shorts that join in, remember, if you join in, you will be part of that crowd. And I can counterbalance that again with the counterpoint theme by saying that at the same time, everyone seems to own the same thing. So a lot of these trades are crowded, which again argues for downside because crowded trades usually become a problem. So, like I said at the top of the video, there's nothing here that I can say or share with you to cut to the chase and saying this is especially with the wild cards we're facing this week, that hey, this is what we have to, this is how I would bet on things. What I would do is just be smart as I can, and I would let things unfold, and I would try to go with them, and I would be disciplined. I'd be rolling a little bit more quickly than usual on both sides, right? On short and long, because the potential for a short reversal is there, because they do that until trends are really cracked, and we have yet to crack the trend, right? So you've got to just always keep that in the back of your mind. Here we had XHB. We do look at this. Again, this is exactly why I do not trade. I say it every week. This is why I do not trade my opinion, right? Because this, in the face of everything, this is held up. I do think that inflation and rates and wages not keeping up and so on and so forth, my overall sort of simple macro take was that higher rates are going to hurt a very debt-dependent consumer, debt-dependent economy. And I think they have been not helping and hurting a little bit, but because of the housing mania, somehow this has still been bulletproof. It just made a new high. But there's your support line. You may as well use the 20-day. So if you're someone that can't help themselves and wants to say, well, I just saw that rates are not coming down according to the Fed, the way that the market, again, the way that the market has been saying they will, then you could say, okay, then you could trade that XHB and use the 20-day. But again, you don't get the follow through, right, and you start to get the reversal, you've got to pick that spot. Here's your break of support, not only in the form of the gold 50-day, but our support line that I just drew. And you can see that IYR, which is one that I mentioned, this was breaking down. So we did have a bearish idea that came into here. So there was a little bit that way in in the form of UOA in terms of an opportunity to trade the downside. I think copper's been just being copper, right? There's not much happening here. I don't think the rest of the world is on fire, but they did move this up. As you can see, we've been noting it's gotten a little bit better, kind of hung in there, it was near the top of the range. So it did burst through. We'll see if that turns out to be anything great, but it's got to probably at least get through here, right? That before you start thinking, okay, this is really something wonderful. I don't know to what extent that nice move there is attributed to serious demand, people being short, stimulus from Asia, whatever the case may be, right? Here's your oil future. You've got this threatening too, so you got to be on guard for that. We have put quite a few little names in. We had, I can't remember them all. Baker was one. I've seen a couple that we got in. There hasn't been as much paper as I would like to have seen, but we've gotten in where we could with some of these UOA hits in charts that look good, in sectors that look good, in a market that's still been acting bullishly overall and holding trend right until really the last couple of weeks. So overall, there's that, and that. I'm trying to think if there's anything else I can share before we wrap up, but the main message just remains be careful with everything, because I think the potential to get short could emerge here this week. And we all know that if you do that in front of the Fed, you could be facing shenanigans, extra shenanigans versus normal. So again, be careful. Realize that if they don't allow it to crack and they start reversing it, you should probably, in most cases, just say, I'll be out for even, I'll be out for a small loss, I'll be out for a small win, whatever. But I'd rather wait and let's see what other price action develops from here, and maybe I'll get back in, unless you have really serious conviction. If you've got really serious conviction, it's a different story. But if you don't have the really serious conviction, right, I think it's usually just better to either get out or neutralize, depending on what you want to do. Amazon, this was interesting because we had this as one of our names for trading this week, and it did actually manage to put a nice little pop together. But you could see by the end of the week, it was just about a little bit lower than where it was before. So I think on that Friday, it closed at 175.35, despite coming up here, right, and making a nice little pop to the upside from where it was on Tuesday when we initially put the trades out. It put a little something together, but it had a really rough Friday. It's right on the 20-day, right? So that's another obviously larger name that could crack right there. We already talked about Apple. Let's take a look at Google, right? Just because these are the big weights, and I'm going to wrap it up on this, I think. Great run. I think we had that in something too. I can't remember what it was, but hesitating, right? It couldn't hold the 50 as of now. They're in gold. So again, if that can't get back above there and hold that, you should probably be concerned about that. Meta, which has been just for a while, just incredible, an incredible stock. That is looking a little concerning, I think, right there. You can see that. You see, like, after the gap and right new high and then just working its way down. And if this low gives out, you could have a new low since this high was put in. There's plenty of air there. So just be careful on that one, right, for now. And also be careful if you're drawn in as a short and they don't let that go down, because that'll draw a lot of people, and that gap will draw a lot of people in, and you'll have a lot of company. Microsoft obviously fared really well until Friday, but I think that looks a little bit better, right? It's holding above all the SMAs, and as of right now, it would take a little bit more weakness for it to crack, and it would certainly take a lot more weakness for it to crack the 50. Let's go to NVIDIA. Now, this one also, right, this came off a lot. It's kind of got a short-term triangle there, right? If we expand this, it'll probably be, come on, there it is. I think, come on, guys. There it is. Yeah, a little bit of a triangle sort of working in there. I'll draw it just to highlight it a little bit, but I'm sure you can already see it yourself. Come on. Yeah, Thinkorswim's acting slow here. And so there's your triangle. And usually in an uptrend, right, you would favor the upside here in a triangle. So that's somewhat, depending on how you want to draw that exactly, you could call that somewhat symmetrical with no heavy lean. But in an uptrend like this, it's good. Problem is, right, you became extreme overbought. So that makes it a little bit maybe less reliable as an upside breakout that you would probably lean towards. When I mean lean, I mean just psychologically or mentally lean, not lean that way already. I would rather trade it once it takes out the resistance or support level and then get involved and manage it from that point. I don't want to be involved in it, unless I've got a strong lean for other reasons, which is entirely possible. But otherwise, I think you have to wait for this one. If it does break down, I think your 20-day makes a lot of sense there. And because that has the gap, and it also has a couple former highs before pre-gap, right? It closed there, this high here. So keep your eye on the 20-day there. Obviously, up in here near the highest close would be your target, probably to the upside on something like that. But you have to admit there's a little bit of vulnerability there. The only thing that about Tesla is that it's oversold. Otherwise, right, you can't really like that. You could maybe like it that it's too stretched right now to the downside. It's oversold. I see a little bit of a reversal pop type trade. You might be able to make that argument. I would still wait for it to start showing me something before just buying it here. But I'm just saying that overall, it just doesn't look good, right? I think that it's got its technical work cut out for it to do something. Another thing that reversed, I think, was Netflix. It tried to get through the 620 plus area several times last week. I got a bunch of alerts on it. Even like, was it this day here? No, it was on Thursday and Friday. It must have been. I got two alerts that came up because if the market was able to get back on its horse, I was ready to possibly add a bullish idea in there, but the market just couldn't perform. And so I just held off in adding, a bullish idea in there. But it was obviously working really well and trying to work back towards the highest high. But that's a rough one. That could be under pressure quickly on the 20. So, right, when we're pretty far away from things, we don't really have a lot to worry about when we're just upsloping and you're far away from the 20-day, which I think is a pretty significant moving average. But when you get close like this, right, that's not really even a full ATR away from it. So a lot of these stocks are not far or are already at levels that are, we could call precarious, right? So when you see these big weights like that, you see what we saw in the sectors with inflation being maybe unfortunately enhanced by XLE, staples hanging in there and discretionary getting hit, XTN not looking good, financials looking tired, former leaderships XLK and XLC not being able to get it going quite yet. All these different factors that we talked about. This is this is just not a great. That's not it either. Come on, where's the where am I? Is that it? Yeah. So all these factors we talked about will be covered these sectors, and a lot of them also like right on support or right below support. So there's issues out there, right? That this is not a week that you can just gloss by and say, the more the merrier. If you do get bullish performance, I think it's going to be from having sucked in some fresh shorts, not allowing the market to fall, turning it around on those people. Probably got a lot of company that joins it if there's a little early week weakness, and then putting the screws to people using the tech conference and possibly the FOMC as a rationale or cover story for that. So problems emerging, problems beneath the surface, in terms of the new high, new low type stuff we've seen. Recently got super stretched. The other side of super stretched is usually underperformance, reversion, retracement, reversion to the mean type stuff. So just definitely more of a cautious kind of approach. I'm a little bit, just like I have been the past couple of weeks, a little more concerned about things, given the total sum of all we've looked at. So I do hope that this combined video on St. Patty's Day helps you out this week or some week in the future. I want to thank everyone for tuning in as always. I hope everyone's well. I hope everyone has a great St. Patty's Day, great conclusion of their week. I hope everyone's nice and nimble and disciplined in this FOMC and World's Greatest Tech Conference week that is just in front of us. So everyone take care, and I'll be back in touch as usual during the week and next weekend. Thank you.